Hello everyone, welcome to our first part of our discussion of Chapter 3. We're focused on the when to recognize income, what needs to be included on the tax return. So when we talk about income recognition for tax purposes, that means that it must be realized and earned, meaning we've done something for the money that we've received. We've earned it, just like you talked about in early accounting classes. The idea of income realization or recognition. And when we say we're going to recognize it, that means it needs to be put on the tax return and included in gross income, both those things. So there's a couple of things that we put on the tax return that are not actually included. For instance, municipal interest is shown on the tax return, not tax-exempt interest, because we'll see it's used in some calculations, but it is not included in gross income. So technically it would not be recognized and included in gross income. If it's not in gross income, then obviously it can't be part of our taxable income, as we learned in our tax equation. Okay, so that's what we want to focus here. There also needs to be an actual transaction that occurred where we receive economic benefit. The transactions actually happened and not given as exempt in the tax law. Any kind of income is taxable or included in gross income, recognized, unless there is specific rules to say otherwise. So the default is always that it should be recognized or included in our income. So most people, certainly almost every individual that you will encounter, is use a cash receipts and disbursements method. So we spent a lot of time in earlier accounting classes talking about accrual accounting, where we record things when they are earned or used, even if they haven't been paid or that sort of thing. And for tax purposes, the tax law wants us to recognize income when it is actually received. All right. And what we talk about that is constructive receipt, when we have the right to control the income. Now, just so you understand, it does not have to be cash in every instance. For instance, if you do something for someone and they do something in return, they provide you with services, you have income, and you have constructive receipt, even on the cash basis, because you received services and you record that in your tax return, or recognize that on your tax return in the year that you receive the services back, if you will. Or if they give you an object or something other than cash, it still applies when you have control of that. That is income based on the value of that item. So that property, when you receive it, let's say you do somebody, you power wash somebody's house, and they in turn give you a piece of machinery. Okay, your income is when you receive that machinery for that power washing, even though it was not in cash. So, some items that we need to speak specifically about, okay, in terms of included in gross income. Interest is a big category, all right? So the interest that you most likely are going to see from banks, credit unions, that sort of thing, typically if that's more than $10, they're going to send an actual document called a 1099 INT, similar to what you're used to getting as a W-2. There are some specific types of interest that have are mentioned in the tax law as having special treatment. For instance, Series E and E savings bonds. Okay, it's taxable, but it has it can be taxed over time, even if you haven't received it, or you can choose to receive, at maturity, you can have it taxable all at once. There is interest that is tax exempt. Okay, so it still has a place for it on the tax return, but it's not included in gross income on the tax return. And that is debt interest paid by a state, county, okay, city, school district, any of those typically a governmental entity that is not the federal government. You may also get interest from if you sell your house or sell your property and you, instead of getting all the cash at once, you provide them with financing. They pay you off over time. That's going to have interest. If you make an installment sale, we'll talk more about that in a later chapter specifically, but that interest is taxable. All right, we even can have situations where even though we don't charge interest, if it's a big enough amount, you can actually have to impute the interest as if it was being paid. Okay, and all of this is reported if it's more than $1,500 on Schedule B. You can just put it directly on your 1040 if it's less than $1,500. Otherwise, you should file Schedule B and attach it to the 1040, and the Schedule B flows to the 1040. Dividends are very similar. Dividends are on stock rather than interest, which is on loans or other types of debt investments. Dividends are distributed to shareholders from the corporation. It is their profits they've earned. Okay, and we'll talk when we talk about corporations way at the end of the semester. We'll kind of revisit this idea as to whether or not the dividends are taxable. But right now, we're just going to say if it's a dividend from a corporation, then it must be reported on the tax return, is recognized on the tax return. Now, this is a situation where it's always included. Dividends are always included in our gross income. So if the question is how much is gross income, we should include the dividends. But there is a classification of dividends which are called qualified dividends. All right, and those are from domestic companies and specifically from the retained earnings, and not dividends on, say, mutual funds or other investments. These qualified dividends are taxed at a different tax rate, different tax brackets than regular income. It's not that they're not part of income, it's just that they're taxed. Now that rate could be as low as 0. So even though your tax rate is 0. It is still included in income, and you see the thresholds. If married filing jointly up to $83,350, that if you have qualified dividends, those are taxed at 0. And you see the different ones for the different filing statuses. And then they're taxed 15% all the way up to $517,000. And then over that amount of income, they're taxed at 20%. So you have to be making a lot of money to have 20%. If you'll notice the tax brackets in your tax rate table, this is quite a bit better or lower, bigger tax brackets for lower rates than the regular income. So that means that this becomes a incentive to have dividends as income. You're going to pay less taxes on it, qualified dividends. The theory being that income has already been taxed at the corporate level, meaning the corporation already paid taxes on that income, and therefore you're paying it again. So you should get a little bit of a break here and not have to pay as high a tax rate. Some other things that might come up: if you have investments, stock dividends and stock splits are usually not taxable. They only in very specific situations. And again, we come back to Schedule B. So Schedule B has both interest and dividends of more than $1,500. All right. Something you might not think about: if you get a refund of your prior year's state income tax. Okay, so that's what we're talking about, state or local, but most of the time it's a state income tax. If you get a refund, it's taxable to the extent that it was deducted the year previous as an itemized deduction. Meaning, did you get a tax benefit? It's a tax benefit rule. If you got a benefit in the previous year, when you get that money back, since you deducted it, okay, then when you get that refund back, it's kind of like you took too much of a deduction, therefore you have to put it in your income, okay? And this is only the amount that is received that if you deducted more than that as on the Schedule A as an itemized deduction, okay? And we'll come back to this itemized deduction idea a little bit in Chapter 5, but it's a tax benefit. If you got a deduction the year previous, and remember, you deduct the higher of your itemized deduction or your standard deduction. If you use the standard deduction last year, then your tax refund didn't give you any benefit. Your state income tax you pay didn't give you any benefit, and therefore your refund isn't taxable at all. So if you didn't itemize, it's easy. But as you see here, it could be part of your refund if it was made your itemized deduction go over the standard deduction. All right, one of the difficult things in the tax law has to do with Social Security. And that's because it's partially taxable, okay? And this is how you determine how much of your Social Security benefits are included in your income as gross income and then therefore taxable income. So what you do is you figure out your provisional income, all right? And you have to calculate that and look at it compared to some thresholds to determine. You will never have all of your Social Security benefits taxable. It's always part of them, never all of them included in income. And on the tax return, you'll see the 1040, there's a place for all of your benefits and the part that is included in income. So before you know what that part is, you have to go through this process of calculating provisional income. And you'll see the provisional income includes some things, okay, that we already said is are supposed to be excluded, meaning tax-exempt interest, for instance. You have to include that in this preliminary calculation. So you go through, you put all these things back in, and then you add 50% of your Social Security benefits. You look at half, okay? And what will basically happen, okay, is that you'll have 50% of your Social Security benefits are taxable if your income's high enough, okay? And it could be as high as 85%. All right? But only if your income exceeds those thresholds. And here's our thresholds. And you see they're pretty low, and they haven't changed in many years. Okay? So if you're married filing jointly, all right, and your income is under $32,000, none of your Social Security, okay, none of your provisional, if your provisional income, remember, you got to add some things back. You got to include your tax-exempt interest. If your provisional income is under $32,000, none of your Social Security benefits are taxable. If it's between 32 and 44, all right, then it is the lower of the two amounts. It's lower of 50% of your Social Security benefits, or 50% of the amount your provisional income is over the $32,000, whichever is lower. Once you get to over $44,000, then it is 85% of your Social Security benefits, or 85% of the amount you're over 44, plus 50% of the difference between 44 and 32. Okay? And then it just works with different numbers if you're single, hetero, household, or qualifying widower. Okay? So here's an example. Okay, your qualifying widow, she receives $7,000 Social Security benefits, $19,000 interest income, $5,000 of non-taxable municipal bond interest. Now, remember, normally $5,000 is not included in gross income, but because there's Social Security, okay, we have to calculate provisional income, which is half of the Social Security benefits, $19,000 of interest income, and $5,000 of the non-taxable. So that's $27,500. Okay, so Karen will report, where does she fit? She's between, okay, she hasn't reached the top one threshold. Okay, she's over here. She's in between these two. So she'll report taxable Social Security benefits equal to the lesser of half of the Social Security benefits, which is $3,500, or half of the amount she was over the $25,000. So it's always the lower of the two amounts. Just a couple other things that you might not think of as income included in gross income. Jury duty pay, not a lot of money, but you got to report it. Prizes and awards, okay? Forgiveness of debt. We'll do a little discussion of that. And if you receive insurance proceeds in excess of the adjusted basis, if they pay you for your stuff that gets destroyed and you get more than what you paid for it, so that could be income.